Let's talk about one of the most foreign concepts in real estate right here in the Greater Toronto area, and that is cash flowing properties. For the last 18 months or since COVID started, finding cash flow or any sort of yield in the GTA was next to impossible because of all the froth and all the craziness in the market. Well, here we are. Now it's 2022. The froth is out, rents are going up, and it looks like cash flowing properties are becoming a thing again. You don't have to drive to Sudbury or Belleville or all these secondary markets that investors went chasing yield. Let's get into it. Hi, my name is Vassil and I'm a chartered professional accountant by training. I'm a full-time realtor that's built and invested in real estate right here in Toronto, York region, and in secondary markets. Now let's get into this video and let's take a look at some cash flowing property. Here's a case study for this video. This is a property I walked about a week ago. It recently sold for $851,000. It had 9 offers, which is quite a bit for a property right now, considering most people are not even getting showings. This is a semi-detached raised bungalow, which is a great setup. You have bigger windows in the basement, so it makes it great for a little duplex or an in-law suite in the basement. Walking the property, I liked quite a few things about it. There was privacy. Obviously, it's not perfect, but the entrance was on the side, something I really liked, not in the back. This gives privacy for both people living upstairs and downstairs. You're not seeing each other kind of coming in and out. What I really liked about this particular spot is that in a lot of places, usually the laundry is in some sort of an awkward configuration, or there's 2 laundries, one upstairs, one downstairs. The way they did it here is you would enter from the side, you come down here, and the laundry is shared between both units, and the second suite right here still has privacy. A little kitchen downstairs in the basement. For the most part, this place was fairly clean, it was well kept. I had no issues with it. What I like about this particular property is that, number one, there is a little bit of privacy. There's 4-car parking. You can't see it right here, but there's a parking pad to the side as well, so you're not shuffling cars around. There's a French immersion school just down the street. It's a neighborhood that's starting to pop up right now. You see a lot of development going in, a lot of bigger homes being built. So this is kind of what you want to see as somebody trying to get in an area where you want to attract a good tenant pool. The other good thing about this property is it has had a lot of upkeep done. So it has a new roof, it has a new furnace. The inside was very clean. It's turnkey, it's livable, you don't have to do anything. Now let's deep dive into the numbers. This is the RBC mortgage calculator. What I've done here is, I'm assuming at $851,000, we're putting 20% down. The current 5-year variable rate right now on a 30-year is 3.45%. Here's my payment at just over $3,000 on this property right now. Now, as a prudent investor, we obviously know interest rates are going up July 13th. Variable rates do not follow a linear trajectory. So just because rates are going to go up by 75 basis points doesn't mean that variable is going to go up by 75 basis points right away. We do have to assume some worst case scenarios. So if I've added a full 1% increase to my variable rate, I've put it to 4.45 over a 30-year just to see if rates did continue skyrocketing, where does that put me? My payment becomes almost $3,500 for this property. I'm going to run these scenarios on this property just to show you where the cash flow is and whether or not this makes sense over the long run. As an aside, just to give you my assumptions for the rent that I got of $3,900, this is a property a few streets over that was split in a similar way as a duplex. They originally had rented the first floor for $2,300. I think that lease might have not gone through, so they rented for $2,150. It was not as nice as the one I'm showing right now. I think $2,300 in today's market is totally doable. And then the basement of that property was $1,500. I've said for hours it's $1,600. Again, nicer property, more private, and it is now July, and rents are continuing to go up. So it's a very reasonable assumption. Now let's use our trusty cash flow model. Again, I want to reference that this is a tool I use at a point in time. This is not something I'm going to rely on long term to find out exactly how much money I'm going to make into the future, right down to the penny. This is a reference point tool. That's it. We don't even know what's going to happen tomorrow, let alone 10 years from now. But again, without a reference point, it's very hard to gauge what investment makes sense and what doesn't. So, by the way, if you want a copy of this Excel model, just email me and I'll send you a copy. I use it for pretty much everything I do because it gives me some sort of a baseline and a reference point to find out, hey, how does this investment stack up to this one or that one? Purchase price of $851,000. The mortgage we're going to have to take on is $680,000. Interest rate right now it's 3.5%. Purchasing fees 2.3. CAM, this is basically usually used for condos, but this is my maintenance fees. I'm assuming I'm going to have to accrue at least $200 a month in maintenance for appliances or whatever repairs I have to make, even though this is not cash out. Eventually it will be. I'm assuming this is going to grow at 3.5%, a little bit higher than our typical 2% inflation because everything is going through the roof. Occupancy, I feel on something like this is going to be pretty good simply because it's family-oriented type of property in a very desirable neighborhood, so I don't think I'm going to have much in the way of vacancy. my property tax, the rent I'm going to get, the rental growth rate, and then my insurance and miscellaneous expenses like hot water tank. The key item here is I'm putting an extremely, what I feel is a low appreciation number for GTA real estate. I'm putting 3.5% over the next 10 years. This property might actually drop in value over the next 18 months. That's a very high possibility, especially the way interest rates are going. But I think over the long run, 3.5% is likely. And we can get into that in another video, but all I can say about Toronto real estate is that as long as we're bound by incompetence in the government and red tape and bureaucracy, existing housing inventory is just going to continue going up because we cannot build in this city. I'm not going to go through all the calculations. All I care about at this point in this model is what my IRR is, and we're looking at 15%. For a property with 20% down, 15% IRRs, this is a great baseline to start at. I've run this exact same model running a worst case scenario, and I've also run it for a best case scenario so that we can see how this IRR compares and what type of cash flows we're looking at. So let's review our three scenarios. Our worst case is if interest rate is 4.45 over the long term, appreciation is only 2.5%, we're going to be cash outflowing about $200 a month. Our IRR is just under 13%, so this is not very attractive. However, for a worst case scenario, I think this is actually not that bad. Our most likely and immediate scenario is this right here. 3.5% interest variable, 3.5% appreciation. Here's our rent. IRR is at 15%, and we're cash flowing about just under $200 per month. Our best case, let's again assume interest at 3.5%, but appreciation is at 4.5%. Our cash flow metrics stay the same. Our IRR is shooting up to almost 17%, which is fine. Now, this is just the first year of operations, obviously. In our cash flow model, we've discounted using the interest rate so that we have the fair market value of the entire investment. But I just wanted to show you that we're actually seeing cash flow. And this is, again, something that's been very rare. I can't remember the last time I've seen it on a residential type of deal like this, simply because prices were way too high and rents were not that high at all. There was cash flow in some more obscure deals where there was trickery and, there was probably some sweat equity that needed to be put in. But now to see something like this under $1 million that's cash flowing, that's pretty impressive. Obviously, the catch right now is we don't know how much more interest rates are going to go up. So obviously there's some downside risk there. But the cash flow from rent is very attractive and it doesn't look like it's going to let up. And rents are usually propped up by inflation. The other thing is that qualifying for a mortgage is more difficult now because of interest rates, so a lot of people are electing to rent. So I think the tenant pool is also growing, not to mention all the immigration and people coming into the GTA. I hope you found this useful. If you want a copy of the cash flow model, just send me an email and I'll send you a copy of it. You can use it. I can help you use it if you're confused about certain parts of it, and I'll see you in the next one.